In other videos, we've looked at the ways in which fiscal policy can be used to influence the macroeconomy. The other main policy that we refer to as a demand-side policy is monetary policy. And whereas fiscal policy was all about taxes and expenditure, monetary policy is the use of monetary tools in order to try and control the level of activity in the economy. And when we think about monetary tools, there are some basic options which are available. And these three tools are the central bank interest rate. It's called the base rate or the repo rate, sometimes depending on exactly which country and which terminology is used. The money supply, which in recent times has taken on the name quantitative easing because of the way in which it's done, but basically the intention there is to increase the amount of money in circulation in the economy, or other tools. And there are some other things which are being tried, particularly at the moment, as we'll talk about in another video when we evaluate these a little bit more. So the other tools that would include things like changing the reserve requirement ratio, so how much deposits banks have to keep in deposit form. It would also include things like forward guidance and stuff like that. Now, those aren't explicitly required in the A-level economics course, but an understanding of the fact that they exist at least would be useful. But the main tools at the disposal of central banks as far as monetary policy is concerned are their central bank interest rates and the money supply. So I'm going to look at this in the context of the UK. So we're going to be referring to the Bank of England and so on. So before we actually start looking at the tools at their disposal, let's think a little bit about what the Bank of England is and what they consider before they make these sorts of policy decisions. Now, as we said, the Bank of England is the central bank for the UK. Different countries obviously give their central banks different names. You may hear the Federal Reserve is the central bank for the United States, European Central Bank for the Eurozone, and so on. But in the UK, it's the Bank of England. So a couple of things about the Bank of England. Firstly, since 1997, the Bank of England has been independent of the government. So the idea with that was to take away the political influence on interest rates. And the remit that they are given by the government, and this is the important bit, is that they are to target medium-term inflation of 2%. That is the sole quantified remit of the central bank. So, in theory, that's the thing that they're supposed to be bothered about before all else. They are allowed to deviate from that by 1% in either direction in any particular month, and if that happens, then they're considered to be within tolerance. If it goes outside of that, so if inflation goes below 1% or if it goes more than 3%, then the governor of the Bank of England has to write an open letter to the Chancellor of the Exchequer, explaining why that's happened and what the Bank of England is intending to do about it to bring the rate of inflation back within tolerance again. So that's the main remit of the Bank of England. But as the central bank, they do have other functions, and it's worth just thinking quickly about what those other functions are. So the first thing is that the central bank is not an institution where you as an individual can deposit money. So it's not a banker for the general population. It is, though, a banker for the government. So the central bank acts as a banker to the government and handles the accounts and so on for the government. They also act as a banker to other banks. So high street banks within the economy or other forms of banking institution within the economy, they will hold accounts with the central bank, and that's the way that they actually manage their reserves and so on. And that's also the mechanism by which changes in interest rates actually pass through into the high street banks. This also includes an important function known as the lender of last resort, and this was tested in the financial crisis back in 2008, where if a bank is experiencing severe liquidity problems, then the central bank should step in, and in order to maintain the stability of the financial sector, the central bank should make sure that bank maintains its liquidity. The other role, which again has become much more important since the financial crisis, is the role of the financial sector, and to make sure that the banks and so on are behaving in accordance with the rules of the financial sector and so on. They do other things as well. Obviously, they implement monetary policy, which we will talk about in a second. They are also the institution which deals with the issuance of hard currency, so kind of notes and coins in circulation and so on. If it's a country that controls its exchange rate in any way, then that's normally done by the central bank as well. So the central bank has a number of functions, but the main one that we think about in terms of analysing their impact is this function here, the use of monetary policy. So the next slide is just going to very briefly think about the sorts of things that a central bank might consider when setting that monetary policy. Now, as we've said, the monetary policy is the tool of the central banks, and the entity within the Bank of England that actually decides on the policies is the Monetary Policy Committee, which consists of 9 members. There's a governor, a deputy governor, and then a number of other appointments with experience in kind of the financial sector, their economic theorists and so on. And they meet every month, and they make the decision on the monetary policy. And this slide is just going to very quickly think about what sorts of things they actually take into consideration when doing that, because actually they think about an awful lot. Now, again, remember here we've got to think about their target is this 2% inflation value. That's what they're aiming for. But actually there are lots and lots of things that go into the inflation outlook. So one of the things that they will think about is what's going on in the money markets and financial markets. So they will take account of the amount of money, the amount of debt which is going on, market interest rates. So that's not the rate of interest that they set themselves, but the rates that the banks are setting between each other, the exchange rate of the currency and what's going on there. They'll also start to think about asset prices, so what's going on with house prices, the stock markets. So lots and lots of things going into that section. They also think about the level of demand within the economy, the output essentially. So that's aggregate demand. So that's all the consumption, investment, external demand. So that means kind of the net trade balance and so on. So they will look at what's been going on with those and the forecasts of what's going on there. They will also look at the labour market. Labour market obviously is a key determinant of wages, which are a very important part of firms' costs and therefore of inflation. So a good understanding of the labour market, so the levels of employment and unemployment, wage growth, non-wage costs and so on, what's going on in the labour market. And the final main section is, I suppose, perhaps in a way the more obvious one, the one where they look at actually what is going on with prices, what's going on with the consumer price index, producer prices, which are often different, and so on. So lots of economic data that they consider each month. And then at the end of their considerations, they will vote on whether to make any changes to the monetary policy stance. And it may well be that they think actually the economy could do with a little bit of stimulus, in which case they will do some expansionary monetary policy. Or if they feel that inflation pressures are building in the economy, they may act to try and reduce those. That would be known as contractionary or deflationary monetary policy. So what we'll focus on now then, briefly, is these actual policy decisions. What actually is it that the Monetary Policy Committee can do in order to try and influence the level of economic activity and inflation? Now, it's a relatively complicated picture in terms of actually how an interest rate change, and we'll deal with that first, how an interest rate change gets into the real economy. It's a fairly indirect process. It's also very general in terms of its impact on the economy. So it's quite hard for the central bank to target specific aspects using the interest rates. Quite a big hammer to wield, and it affects lots of different aspects of the economy. But it is important to think about how in fact, let's be a little bit more specific here. So we've got the central bank interest rate, how that actually gets through into the economy. And obviously the main thing that we are dealing with here is inflation at the end of it. That's the remit of the central bank. So let's quickly go through and think about how the central bank interest rate might feed through into inflation. Now, the first thing to think about is that the central bank interest rate should feed through, hopefully, and influence market interest rates. Now, market interest rates are the interest rates which are actually paid in between banks and obviously charged by banks to households and so on. The central bank rate is set by the Bank of England, but obviously the high street banks can charge interest rates as they want. So one of the things that they hope will happen is that the central bank interest rate will feed through, because the high street banks have their accounts with the central bank. It will influence the interest rates that they are setting. Another relatively direct consequence of this will be asset prices. So when the central bank if the central bank were to reduce interest rates, that would obviously mean that that would disincentivise depositing money in banks and would incentivise putting your money somewhere else. So that's likely to lead to an increase in asset prices. So you would expect a fall in the interest rate to boost the stock market, to increase house prices, and so on. So that would have an impact on asset prices. Another one which certainly, if we have a Keynesian hat on, is very important, is the expectations element of it. So what the movements by the central bank mean going into the future. And then the last main one is the exchange rate, and this is influenced by flows of what we generally call hot money. So if a central bank reduces interest rates, that makes depositing money in that economy less attractive, and we would therefore expect a net outflow of currency from that country as depositors withdrew and went and deposited their money in a country which had a better return, and that would increase the supply of that currency and would mean that the currency weakened. So those are kind of the relatively direct impacts of the interest rate. What these have then is an impact on domestic and external demand. So this is a demand side policy, and therefore the market interest rates, the asset prices and the expectations and so on will feed into domestic demand and also into external demand as well. So all of these will feed through into these different elements of demand, but importantly, these are obviously the aggregate demand components. So this then will obviously impact on the level of aggregate demand, and as we know, the level of aggregate demand will influence inflation through demand pull inflation. Now, there's another effect going on here as well, which is that the impact on the exchange rates will also have an effect on import prices, and that will have an impact on the short run aggregate supply, and that, as we know, will also have an impact on inflation from the cost side. So there's quite a complicated channel here, as you can see. So that means any monetary policy question that you answer, you should try and deal with this in as much detail as you can. But again, I mean, remember, even just, for instance, if we were to take this link here from the market interest rates to domestic demand, domestic demand includes the C, G, and I components. And even if we just take consumption there, then a change in market interest rates could affect consumption in a number of different ways. It discourages saving, it stimulates consumers to borrow more readily, and it makes their existing debt, things like mortgages, cheaper to service. So there's a huge amount of analytical potential in here. Where QE fits into this is that basically QE is an alternative approach to essentially kind of try and feed into these areas here. So it's a way of trying to, I suppose as well, it does actually kind of come all the way down here as well. So QE is an alternative starting point, really. So it aims to basically enter the same sort of analytical chain, but just to do so from a slightly different angle. Now, normally QE is used once interest rates have basically run out of scope. So once interest rates are so low that they can't really be lowered any further, then central banks would start looking at increasing the money supply through quantitative easing as an alternative way to end up with the same sort of outcome. So if they're trying to stimulate the economy, you lower your interest rates, but when your interest rates are very low, they run out of scope to do any more. So then QE can then hopefully kind of continue that same channel. So a lot of analysis there, but it's really important just to work it through step by step. Think about the different aggregate demand components. Think about the different types of inflation, and you can score very well on monetary policy without having to go too far away from the main concepts involved.